It's always funny. I get to come in and watch. We're on camera now, by the way. How's it going, everybody? Geoff Zahler, Mike Fondi.
Hi there.
We're going to talk about an interesting topic that, well, actually, we find it interesting. Most people probably fall asleep when you talk about math or finance or interest rates. But if you're looking at buying or selling a home, and I say selling a home too, because it really, really matters. What somebody can buy, how they can buy, what they can buy, it really depends on the interest rate here. And you know, our crystal ball really is about as cloudy as everybody else's is, but you know, Mike and I both have finance degrees, in backgrounds in finance, and it's really important, right? It's part of our business. We leave the heavy lifting, if you will, to the lenders.
Of course.
But we want to at least bring some light to the whole interest rate topic. People are always wondering if they're going to go up, they're going to go down. So we'll talk a little bit about that. But just want to get started and send it over to you.
Yeah. Interest rates have changed since the election.
Mm-hmm.
They went up a bit right off the bat. They've kind of stabilized, but with the Federal Reserve increasing the Fed funds rate, the last meeting that they had, I think everybody is assuming rates are going to go up from here.
Right.
They've been quite low for some time, but
A decade, if not longer. Right?
Absolutely,
Yeah.
absolutely. I remember when I was in high school, way back in the 80s, the interest rates were like 20%. So even if they go up, they're still going to be great compared to where they were. But you know, we thought it might be interesting to give you a real example of, as interest rates increase, what that actually means for a house payment. And for we've talked about buying power before. When we're talking about buying power, what we're talking about is the amount of home you could buy.
Right.
Really. So start with just a real example on a house payment to help illustrate what that means. So let's start with a loan amount of $230,000. Try to put some numbers on the board here. I don't know if you can see them or not.
Why 230?
$230,000 is the median single-family home sales price here in Las Vegas.
Okay.
So that's a good place for us to start. That's the sales price, but we're going to use it as a loan amount.
Okay, because every loan has a different product or a different amount.
Down payments.
Okay.
You know, actually, if that's the sales price, the loan amount may be different. But for our discussion, we'll just use $230,000 as a loan amount.
Okay.
Today, the 30-year conventional mortgage is at about 4.5%.
Okay.
Maybe a little less, but we'll use 4.5% as a starting point. That equates to a monthly principal and interest payment of $1,165 per month for a 30-year loan.
Okay.
All right.
That's pretty reasonable.
It's not bad.
Yeah.
Not bad. We ran some numbers. If the rates were to increase, say, 0.5%, go from 4.5% to 5%, your payment would change from $1,165 to $1,306. Okay.
Is that from 4.5% to 5.5%?
Yeah.
Okay, so 1%.
Oh, I'm sorry. Let's do a half. Let's do a 0.5% increase.
Okay.
So from 4.5% to 5%, it would go from $1,165 to $1,235, and then from 5% to 5.5%, it would go from $1,235 to $1,306.
Okay.
So a 1% rise in rates from 4.5% to 5.5% equates to about $140 increase in monthly payment.
That doesn't seem like a lot, but when you think about every single month, so over a 12-month period, you're looking at about $1,500, $1,800 a month,
exactly.
or a year. That's a lot of money.
It is.
Yeah.
It adds up. But I think probably a more important consideration here is, what does that do to the amount of loan you can actually take out? So maybe you could talk about that, Geoff. Maybe a monthly, what your monthly payment is, and how those rates might affect the amount of money you can actually borrow.
Perfect. Well, what we always do is at least here, we know that a lender will talk to you, and we will talk to you also about your top line number, because we work in two different realms, right? We work in the purchase price of a home, which is a very large number, but realistically, on a daily basis, on a monthly basis, if you will, we live within a budget. Or some of us do, some of us don't, some of us should live on budgets. But so there's a correlation to what your monthly payment is. Whoop, getting a phone call. Look, you're already getting somebody asking about information.
Sorry.
what we do is we work on this top end number, right? We're all so focused on what we can qualify for. Part of that's our fault because we look at houses and hey, this house is listed for $300,000 or $250,000. Part of it is a lender's thing. Here's what you qualify for. But when we talk to our clients, I say, okay, look, what are you comfortable with on a monthly basis? So again, a good lender will tell you, hey, here's what your monthly payment would be. And if you have a good conversation, you can have a conversation with your lender saying, I want my payment every month to be in this range because this is what I work on. I don't work on a 30-year amortization schedule. I work on a monthly number. So again, long story short, we came up with a rough, say like you were comfortable, you did your finances, and you're like, I think I can pay $1,500 a month for a home, right? For my principal and interest on a home. What kind of loan can I get for $1,500 a month? So again, we're going to use the 4.5 and we're going to use the 5.5 like you had just talked about. So if you wanted to spend $1,500 a month on your principal and your interest with a 4.5% loan, which is about what current rates are, that would be about a $296,000 loan. So again, we had talked about down payments and everything, but you're looking at about basically a $300,000 plus home for $1,500 a month. Very reasonable. This is what we're talking about purchase price. Now, take that 4.5% and say like overnight it goes to 5.5%. That same $1,500 a month will only actually get you about a $264,000 loan. Okay, what's the difference there? That's about a $32,000 difference. Okay, so in Las Vegas terms,
right?
What's $32,000? It could be the exact same house that has been upgraded versus not. It could be the exact same house with a really killer pool and spa and one that doesn't have it.
Okay.
That's about a $20,000 to $30,000 difference. So overnight, a 1% difference could be that difference between finding the same house with a pool without a pool. It could be an extra 300 square feet of a home. So we're talking about some serious differences. And actually, if the rates we talked about up to 6%, if the rate actually does come up to 6%, that same $1,500 a month, that only gets you a $250,000 loan. And when I say only, obviously there's a lot of products still there that's still higher than the median sales price, so we're still talking about a lot of home. But compared to $296,000 at a 4.5%, you're looking at a $46,000 price difference. Now, we've seen a lot of homes in the valley. What kind of difference in a home are you looking at when you're looking at a $45,000, $46,000 difference?
Big
Considerable
difference. Considerable difference in the type of home you can buy and the area you can buy in as well. So I think you've illustrated really well how important it is the rate consideration as to what a buyer can buy. But at the same time, it affects sellers as well.
Absolutely. It does affect sellers. And we know, without getting, as the finance guys, we can get too in-depth, and this may already be over the heads of some of you. Sellers need to worry about this too. Because if you're selling your home, and all of a sudden rates jump, that person that was able to qualify for your home yesterday may not actually be able to qualify for your home anymore.
Fewer people who will be able to buy my home.
So that could cause prices to go down, but in our market, it's really supply and demand. We're still seeing strong market, but you may just have less buyers. So that's something to consider. And again, we threw some numbers out there. We're not saying we see the market going to 6% anytime soon. However, if I had to guess, I'd say we hit 6% before we hit 3% again. That's something I would probably say. Look, the economy is doing well. The market is doing well, and housing is doing well. So we've been at an unnatural lull for mortgage rates for a decade plus. There is room to go back down, of course, but I think in terms of a longer looking picture, we're heading probably up, not down.
I would agree with that. And as Geoff said, we're both finance guys, so this discussion is pretty easy for us to get ahead of ourselves on. If anybody's got any questions specific on buying power or interest rates and mortgage payments and how they affect each other, please reach out and we'd be happy to try to address any questions you have.
Or more importantly, probably forward you directly to a great lender because this is just the beginning stages. We're not talking about homeowners insurance. We're not talking about that kind of stuff.
Absolutely.
But this is just to kind of give people an idea. This is how we look at things for our clients too. So we're not just out there showing you homes. We're really looking to put a plan together with you so you understand what kind of payment you're going to get into before we even start looking.
Right. And I would also say the idea of rates changing is probably an incentive in some degree for people to make a move.
Yeah.
When I say make a move, I mean if you're a buyer interested in buying, you're probably going to be able to buy more house today than you will in 6 months or a year from now.
Potentially 50,000 more.
Right. If you're a seller that's interested in selling your home, you have more buyers able to buy your home today than there will be if rates go up.
Right.
So
that's at least what our crystal ball's saying.
Yeah. So anything else?
I think that's it. I think our information's on the screen, but you can reach Mike at 606-4660. You can reach me at 758-4699. We'd love to help however we can, and like I said, probably put you in touch with a really great lender that can finish this conversation.
Very good.
Thanks for watching. Until next time, have a good day.
Thank you.